All right, let's talk Zscaler. They just reported their Q1 numbers, and on the surface, they were an absolute knockout. I mean, fantastic numbers pretty much everywhere you looked. But then the market opened, and the stock just took a nosedive. So what gives? That's the paradox we're going to unpack right here.
So, management was out there touting what they called a rule of 78 quarter. Now, for a software company, that's kind of like a pitcher throwing a perfect game. It's a super elite metric showing incredible growth and profitability. So, if the results were that good, why on earth did the stock get absolutely hammered?
And this chart really tells the whole story, doesn't it? Well, all the headlines were screaming, huge beat. The traders, the ones who really moved the market, were digging into the fine print. They were looking at the guidance, and what they found in there was enough to send the stock tumbling. Let's break down exactly what they saw.
Okay, first things first, let's cover the bull case. Because make no mistake, on paper, this was a monster quarter. And you know what? Management had every single right to be celebrating these numbers.
I mean, Zscaler didn't just meet expectations. They completely crushed them. Revenue jumped to over $788 million bucks. That's a 26% increase from last year and almost $15 million more than Wall Street was looking for. And their non-GAAP EPS, which is really the profitability number that matters, came in hot at 96 cents, a solid 10-cent beat. Just really strong stuff. Now, this is where it gets really impressive. This number, 78, was management's favorite metric. So in the software world, there's something called the rule of 40. Basically, if your revenue growth rate and your profit margin add up to 40, you're considered a top-tier company. It's the gold standard. Well, Zscaler hit 78. That's not just good, that's almost double the gold standard. It's practically unheard of. It puts them in a completely different league. And you can see this growth wasn't just some one-time thing. The whole business was firing on all cylinders. Their annual recurring revenue, ARR, was up strong. And this other metric, RPO, which is basically just a fancy way of saying future revenue that's already under contract, it grew even faster. And look at their new AI security business. It's growing at a breakneck pace. I mean, every single arrow was pointing up. So you see all that, and you're thinking the stock must have gone to the moon, right? Well, wrong. The market saw a storm cloud on the horizon, and it all, and I mean all, comes down to the guidance for the future. This is where the whole bear case starts. Okay, right here. This is the smoking gun. This is the math that Wall Street lives and dies by. So Zscaler beat its Q1 revenue target by almost $15 million. Logically, you'd expect them to raise their full-year forecast by at least that much, maybe more. But they didn't. They only raised it by about $11.5 million. Now that rate seems subtle, but to Wall Street, it's a huge red flag. It's a signal that they see things slowing down later in the year. And for a high-flying stock like this, that's a 5-alarm fire. And it wasn't just the guidance, to be fair. Investors also started picking at a few other things. You had a tiny bit of pressure on profit margins, the fact that by standard accounting rules, they're still not profitable. And, maybe most importantly, you have to remember the context here. The stock was already up a ton for the year. Expectations were just sky high. So there was absolutely no room for error. Anything less than a perfect report was going to get punished. And yeah, this quote just nails it. The market wasn't really trading on the amazing quarter that just happened. It was trading on the fear of what might happen in the quarters to come. And that fear of a slowdown, even a tiny one, was enough to completely overshadow those stellar results. So what you have here is a classic Wall Street showdown. It's management's big, long-term vision versus the market's obsession with what's happening right here, right now. You see, on one side, you have management trying to tell this grand multi-year story. They're talking about building this dominant security platform, getting into AI, and eventually hitting over $10 billion in revenue. But on the other side, you've got the market, which can be absolutely ruthless. When a stock is valued as richly as Zscaler, it gets judged almost exclusively on its next move. It's all about the short-term signals and that tricky guidance math. And you can almost feel the CEO's frustration in this quote, right? He's trying to paint this picture of a company just riding these massive waves in AI and zero-trust security. He's talking about this huge long-term opportunity. But on this particular day, the market pretty much had its fingers in its ears. So, where does that leave us? Where do we go from here? Is Zscaler a broken company, or was this just a much-needed reality check for a stock that got a little ahead of itself? Here's our verdict here at the next call. Okay, let's break it down in 3 steps. First, the setup. This stock was priced for perfection, which is always a dangerous place to be. Second, the reset.
That big 13% drop wasn't really about the company's long-term strategy. It was about the stock's price needing to come back down to earth. It was probably necessary. So, our final verdict? We're assigning Zscaler a market perform rating. The company's fundamentals are still incredibly strong, but now the valuation is just a bit more reasonable. And that leads us to our final thought, a bit of a trade idea for the quarter. You know, if you're still a long-term bull on Zscaler, you might ask, does this sell-off create an opportunity? Well, some traders might look at this and see a chance to sell puts. It's basically a bet that the panic is over and that the stock has found a floor right around here. It's definitely a higher risk play, but it's one that's based on the idea that the market just plain overreacted. And as always, we have to say it, this is all for informational purposes. This is not financial advice.